Basically, we've got about $800 trillion of assets out there in the world. Gold is at 30 trillion, global M2, 80 trillion, and Bitcoin, the whole of digital assets is like 3.5 trillion. Okay, so it's nothing yet. But when you use the trend rate of adoption, i.e. the market cap of crypto overall, it is in a secular log regression channel. And you can forward project out where it's going to go. And it tells us by around 2032, 2034, this is a $100 trillion asset. A $100 trillion asset means we're going to create $97 trillion of new wealth, which will be the largest wealth creation in all of economic history in the shortest period of time.
There are moments in every market cycle where confusion peaks, not because the thesis is broken, but because time has stretched longer than most people expected. Prices stall, narratives fracture, and conviction quietly erodes. This is usually where weak hands give up. But historically, this is also where the largest opportunities are being built beneath the surface. That's the framework we need to start with, because what you're about to hear from Raoul in this video isn't a short-term price prediction. It's a long-range macro thesis about scale. Pal argues that the entire digital asset market, still sitting at only a few $1 trillion, could grow into a $100 trillion asset class between 2030 and 2034. Not through hype, not through memes, but through the same force that has driven every dominant asset in history: global liquidity and network adoption. In his words, crypto isn't just another asset class, it's a supermassive black hole, pulling capital in as currencies debase and the world digitizes. Now, if you're watching this and thinking, if this opportunity is so big, why does price action feel so disappointing right now? You're not wrong to ask. Bitcoin has chopped. Altcoins have underperformed. The emotional payoff many expected after the 2024 halving simply hasn't arrived. But Pal's core argument is that this frustration isn't a failure of the cycle. It's evidence that this cycle is different. Instead of peaking 1 year post-halving like prior cycles, he believes this one stretches all the way into 2026, driven by delayed liquidity, broken financial plumbing, and a global system that hasn't fully turned the taps back on yet. And that's what makes this conversation important. Because if Pal is right, then obsessing over short-term candles is missing the point entirely. This video is about why expectations broke, what the macro data is actually signaling, and how patient capital is positioning for what could be the largest wealth creation event in modern financial history. Stick with us through the full breakdown. And if this kind of macro-level crypto analysis adds value for you, take a second to like the video, subscribe to the channel, and let me know in the comments whether you think this cycle really does peak in 2026. Thanks for tuning in, and enjoy the video.
Another way of looking at it is central banks, the number of them who are easing. That leads the business cycle, obviously, because they're cutting interest rates. So that tells us we've got a strong cycle still ahead of us. The one for us that matters the most is our financial conditions index. That's driven by rates, the dollar, and commodity prices. And this chart has been very, very useful in predicting where everything goes. And it tells us in 9 months' time, the ISM should be at 57. And we don't think the financial conditions index is done yet. Another leg lower in the dollar, another leg lower in rates, and what we get is an extension of the cycle out further than 9 months. Again, this is a very good indicator. But we can add to this by thinking about liquidity in Bitcoin. Why does all this matter? Well, because the correlation of the two things, of total liquidity and Bitcoin, are extremely high. In fact, the correlation is 90%. Statistically, that is absurdly highly correlated. When you look at the NASDAQ, it is even more absurdly highly correlated. It's 97.5% correlated with money printing. So money printing is the story that drives this, and then network adoption is what drives the outperformance. So if you think about the hurdle rate being 8%, everything above that is driven by network adoption of the technology. Liquidity, where are we now? Well, year-on-year liquidity is not very impressive. This kind of slow grind higher has been what we've lived through in crypto from the bottom. It's kind of stop-start. Things don't really get going. Some things get a narrative traction, then fall off again. It's because liquidity is not flowing through the system. We've had broken plumbing, and we've had no need to do it yet because we don't have to roll the debt until 2026. When we look at financial conditions, our lead indicator, and put them against total liquidity, well, we've now got a lead, a 3-month lead, and it tells us liquidity is about to explode. And we know that because Scott Bessent's telling us that. They're telling us they're going to add liquidity to the system. We know that because they have to, because the plumbing in the financial markets is breaking as well. So we've got that to come. And then when we overlay ISM, we've got this perfect dominoes of the economy. We've got our high lead indicator, financial conditions, leads by 9 months. Then we've got total liquidity, where Bitcoin and NASDAQ live. And then we've got the ISM, where oil and commodities and cyclical things all live in. So we can understand how the market works over time and asset allocate accordingly. The other thing is, part of that financial conditions is the dollar. Here's the dollar last time Trump was in versus this time. It's scarily the same. It would suggest that we probably have another leg lower in the dollar, which would give us another leg in financial conditions, which means that the cycle extends to the end of 2026, which is why I keep saying it's a longer cycle than people expect. Global M2 is doing roughly the same thing. We had that chop periods last time around with Trump, and again, we get the accelerated part as we go. So that feels like that's coming as well. But we've had a weird world in crypto in the last 5 months, 4 months, is where we've diverged from everybody and we feel now we can't have nice things, it's all over, everybody hates us, it's a terrible world out there. And it's because of stuff like the global M2 chart. That was a chart I was showing for a long time. I said, listen, it's not going to be perfect, and then it started diverging wildly. What happened here was, because of the lack of liquidity in the system, the Treasury began to increase its general account. There was no offset with a reverse repo, and crypto, being the furthest asset out on the risk curve, got hit. NASDAQ didn't get hit because everybody was underweight NASDAQ going into the last quarter of the year, but crypto got hit. And liquidity is still problematic, which is why the Fed started using the balance sheet again. And that's why we've struggled. It's not been easy because there's not been enough liquidity around in the system. Global M2 against NASDAQ's worked fine. And the reason being, again, is because asset allocators were underweight NASDAQ. It had been a good performer all year, and they've had to chase their benchmarks. So we've seen this kind of stuff. Even though we've had kind of fear and greed in technology stocks extremely on the fear side, people have had to chase the market. They didn't do it in crypto because they're not benchmarked against it. But it's still working. But NASDAQ against Bitcoin hasn't. This alligator jaw has opened up. And the alligator jaws, I think, will close because of when liquidity comes in, crypto is the most liquidity sensitive. Against gold, gold actually leads by 183 days. Gold lives in financial conditions world. And again, we've diverged from the gold chart. Same thing, the alligator jaws, same thing, driven by the same issue, which is there's not enough liquidity in the system to flow all the way out to crypto, and we're all stuck there watching the market flapping around while other people are having a party. And it's slightly irritating, but it is what it is, and patience is the game. We're playing a macro game here. We're not playing, hourly charts. We're playing a game of cycles. We're playing a 5-year cycle, not a 4-year cycle. These things take time, and patience is the important thing if you want to capture the returns. Bitcoin against the 2015-17 cycle has been mapping really well. Alligator jaws, again, same reason. Bitcoin against 2021, alligator jaws, same reason. So we've got this consistency across all of the things to show we've had a dislocation. And the question we ask ourselves as investors is this dislocation persistent or temporary? And from the work that I've done and showed you, it's most likely to be temporary. If not, then suddenly the 90% correlation to global liquidity is gone for no apparent reason. And that doesn't normally happen. Another alligator jaws against a different period. Just all of these things. We see it even with the economic surprises index. We get this excess fear gap that's happened in Bitcoin. If you remember, Bitcoin is pricing in an ISM of 46, which is a recession. Yes, we'll have slow growth from the government shutdown and other stuff. We're highly unlikely to have a recession because all the forward-looking indicators suggest the business cycle is going to get a lot stronger. So we've become pessimistic after the washout in October that it's never going to come back. And I think generally that's going to wrong foot people because of the macro work that we do. Financial conditions, same thing, excess fear gap or alligator jaws. We saw that with the fear and greed index getting down to 10. It was the lowest reading in the history of crypto. And that was after a 30% sell-off. And I keep saying with my don't this up thesis, 30% sell-offs are normal. But yet we just cowered in fear when it happened.
What Powell lays out in the first section is essentially a hierarchy of cause and effect. Financial conditions lead liquidity. Liquidity leads risk assets. And crypto, especially Bitcoin, sits at the furthest edge of that risk curve. When liquidity is constrained, crypto feels it first and worst. That's why we've seen fear spikes, broken correlations, and what Powell calls the alligator jaws between Bitcoin, equities, and gold. But here's the key point. Historically, those dislocations have almost always been temporary, not structural. If liquidity truly is about to re-accelerate, as central banks signal easing and the dollar weakens, then crypto doesn't just recover, it tends to outperform violently. This sets the stage for what comes next. The second part of Powell's argument zooms out completely, away from short-term pain and into long-term inevitability. He reframes crypto not as a trade, but as an asset allocation black hole, driven by currency debasement, technological adoption, and global participation. And this is where the discussion shifts from "why hasn't it happened yet?" to "what happens if this keeps compounding longer than anyone expects?"
This is the chart the last time we had the government shutdown. And we're following pretty much that path as well. Again, we're starting to have a slight gap here, but chances are once we get through year-end funding for the banking system and the SLR kicks in and everything else kicks in, then we just start this trajectory higher. And we should just have a strong up year. Obviously, we will have corrections en route. And overall, when we think about this as an asset allocation, crypto becomes the supermassive black hole. It becomes the most powerful asset we've ever had, the greatest performing asset of all time. And everyone thinks they're too late. But remember, we're driven by this debasement of currency. As Lynn Alden says, nothing stops this train. Nothing can stop it until the AI and the robots replace population growth. So it's an ongoing, persistent, secular theme that persistently drives markets, which is why markets endlessly go higher. NASDAQ is one of the few assets that's outperformed this debasement. It's outperformed it by 12.6% a year. So it's been a great asset to own because tomorrow is more digital than today, so technology outperforms. It tends to be network adoption models as we adopt new technologies like we're doing with AI, so it does well. Bitcoin, on the other hand, has outperformed it by 89% a year. So that's a staggering difference in performance. When we look at, and you can't see this table very well, but here's a table from EXPAAM showing all of the assets, and on the left are in orange, the annualized returns. None of those beat the debasement rate. Owning those assets makes you actually poorer. Only up here is you've got US large caps roughly in line with debasement plus inflation. NASDAQ outperforms. Then you've got three crypto there with Solana at the top since it came out at 166% annualized returns. That's the power of this thing. Not only does it avoid debasement, but you can get rich as well if you've got patience. So why bother even owning the NASDAQ when it's down 99.92% versus crypto? Over time, everything underperforms this supermassive black hole because this is a network adoption model on a global scale. So for me, it becomes the greatest macro trade of all time. This is why I care so much about this space, because we can make a lot of money in it. And it's an enabling technology for all sorts of things, including helping people around the world participate in the financial system in ways they couldn't have done. So it's a supermassive black hole that becomes the greatest macro trade of all time. And here's the big trade. This is why I'm in the space from the investment perspective, not from the ideological perspective, which I also share. But from this perspective, the chart's a bit screwy here, but basically we've got about $800 trillion of assets out there in the world. Gold is at 30 trillion, global M2, 80 trillion, and Bitcoin, the whole of digital assets is like 3.5 trillion. Okay, so it's nothing yet. But when you use the trend rate of adoption, i.e. the market cap of crypto overall, it is in a secular log regression channel. And you can forward project out where it's going to go. And it tells us by around 2032, 2034, this is a $100 trillion asset. $100 trillion asset means we're going to create $97 trillion of new wealth, which will be the largest wealth creation in all of economic history in the shortest period of time. To put it this way, it'll create more wealth than all of the Middle East, every Russian billionaire, every US tech billionaire, every finance billionaire, every real estate billionaire on Earth. That's what's here. This is what the game is. Discount me 50%. It's still 47 trillion. So we're only 3% of the way there or 6% of the way there if you've halved my forecast. So that's the game. That's why at EXPAAM we allocate to the world's best hedge funds in the space to capture this trend, this overall trend. That's all we're trying to do, is not up this one trend, which is the greatest macro trade of all time. The final part is what everybody cares about, is the banana zone. When does it happen? And look, that liquidity drain that happened in July onwards has been miserable. But the thing remains the same. We've still not had the last phase. The last phase is the debt refinance, the refi cycle phase. And that is 2026. So yeah, not everything works out perfectly. It's not all clockwork. It doesn't follow M2 tick for tick every time. It won't follow everything that you think it will. But overall, when you zoom out, when you look at the big picture, you come all the way through, the opportunities for outsized returns, even risk-adjusted in this space, are bar none. And it's the best thing that we've ever seen as an asset class.
If we accept Powell's elongated cycle thesis, the implications go far beyond just this market. One possibility is that crypto cycles themselves are structurally changing. As liquidity waves stretch and adoption deepens, future cycles may no longer follow the clean 4-year halving rhythm investors are used to. Instead, we could see longer expansions, shallower drawdowns, and fewer of the explosive but brief banana zone blow-offs that defined earlier eras. That would mean less emotional euphoria, but potentially more durable wealth creation for disciplined investors. Another scenario is that this cycle is elongated for unique reasons: COVID-era distortions, aggressive fiscal policy, and delayed debt refinancing, and that markets eventually revert to a more traditional pattern. Even in that case, the takeaway isn't bearish. It suggests that the peak hasn't been pulled forward. It's been pushed back. Price expectations reset, patience gets tested, but the terminal upside doesn't disappear. It simply arrives on a different schedule than most people prepared for. There's also a third, more subtle outcome: crypto maturing into a global macro asset. In that world, it still outperforms, but not in the chaotic, reflexive way it once did. Volatility compresses at the top, capital allocators replace retail mania, and adoption, not speculation, becomes the primary driver of returns. Ironically, that version of crypto may feel less exciting in the moment, but it's exactly what enables institutions, sovereigns, and long-term capital to fully commit. Whichever path plays out, Powell's central message remains intact. This is not a short-term trade, it's a multi-year macro shift. And for investors who can think in cycles instead of candles, the opportunity is still asymmetric. And drop a comment below. Do you believe this cycle peaks in 2026? Or do you think crypto eventually returns to its old rhythm? If this breakdown helped clarify the bigger picture for you, hit the like button, subscribe for more long-form macro crypto analysis. Thanks for watching, and I'll see you in the next one.